All right, Dmitri, at some point, maybe we just start.
Yes, let's do it. I think it's a good time. Okay, so everybody's welcome. Thank you for joining our webinar on pros and cons of systematic strategies. We have quite an interesting panel today, and it is looking like going to be a promising discussion, quite interesting discussion as well. So to cover the subject, we have John Stein here, CEO of Kettera Strategies, which is a fund-of-fund/platform, and John can introduce himself, and I'll just mention the participants real quick. We also have Prakasam. I'm sorry I don't know how to emphasize the last name. Jack's, sorry for that. Maybe you can correct that. So CEO of Rotella, and then Roger Dowd, Managing Director of AG Capital, and Max Nissman, Managing Member of Linnis LLC. So please, guys, introduce themselves, what you do, and the reason we have these participants on the panel is that they represent different sides of the spectrum here that we're going to be discussed, and that's what will create some contrast and comparison and value for the discussion. So thank you. John, please go ahead.
Sure. Yes, this is John Stein. As Dmitri said, I'm the CEO and founder of Kettera, which runs, among other things, the Hydra managed account platform. We are probably not a fund of funds. We're probably just a platform at this point. However, I have been a CIO of two different fund of funds. One was Efficient Capital Management about 12, 13 years ago. For 2.5 years, and more recently, up until about 5 years ago, at Parker Global Strategies out in Connecticut, where I ran the macro and FX portfolios. That said, we formed Hydra, the Hydra platform, really to be a platform in the truest sense. But we're not a marketing shop. We're not a fund listing service. We actually do full due diligence and research of managers. Now, the big question here, and the reason I'm on the panel today, is not just because we do a lot of research on individual managers, and I think we do know a lot about the differences between discretionary and systematic programs. We deal with it every day. But because of my background and my partner's backgrounds, which are all in fund of funds and portfolio management, we get asked a lot by institutional investors especially, and some family offices, which manager should I pick? What's the best blend for me right now? We do provide that input. We don't work for a bank. We're not bound by bank regulations of conflicts of interest. So we're more than happy to opine on all the managers on our platform in writing and verbally and graphically, as you'll see today. As far as putting portfolios together, we do help our clients do that as well. To date, we have not gotten paid for it. We are paid as platform operators. In a sense, people can tap our portfolio management expertise in our tools, which, by the way, includes AlphaBot, largely us for free, and AlphaBot almost for free. But that's as far as it's gotten. We have considered spinning off a subsidiary or an affiliate of our firm that does nothing but research and put portfolios together. Right now, if somebody does want to professionally pay somebody to put a portfolio together, we actually refer out to fund of funds partners of ours that we work with, and they use us as a platform and them for the portfolio advice. But we give out a lot of portfolio advice anyway.
Okay.
John, I'd like,
sure. Yeah, we need to keep the pace, so sorry for the interruption.
That's fine, sorry.
Yes, so Jack, please go ahead, CEO for Rotella Capital.
Thanks, Dmitri. Hello, everyone. Rotella Capital was, just to give you an introduction to Rotella Capital for those of you on the call who are not familiar with us. Rotella Capital was founded 30 years ago with a simple vision of bringing quant systematic models to Wall Street by Robert Rotella. 30 years later, we remain true to that vision. We offer 7 unique strategies in the managed futures space. If anything, in this world we live in has taught us that we need to be able to adapt to the face of fast-changing macro events or be prepared to become obsolete. We at Rotella have passionately pursued ideas worth exploring and experimenting with our own capital over these past 30 years. We have successfully created technical analysis frameworks, statistical modeling frameworks, and machine learning frameworks over the course of the past 3 decades. Going into 2020, we are offering access to these frameworks to allocators via our fintech SaaS solution QDEC, which lets them adopt these ideas to their existing portfolios. I'm Jagdeesh Prakasam, CEO of Rotella Capital. I would like to thank our hosts, Dmitri, Alexeev, John Stein, and the whole AlphaBot team from Team Rotella. Thank you.
Thank you so much. Roger, AG Capital, please go ahead.
Yes, Roger Dowd, Managing Director at AG Capital. So I just want to give a quick background on Awesome Ghaffar. He's the founder, CIO, and yes, his name is pronounced Awesome. So he graduated summa cum laude in economics from Dartmouth and has an MBA from the Sloan School at MIT. And given that we're in a systematic panel, I thought this was right. So he's the first to admit that his education makes for great marketing on paper, but in practice, it's a handicap that he had to unlearn. So, he's the first to admit that what the economics textbook teach us is not what makes a great trader. So we believe trading is a craft, not unlike the way someone becomes a carpenter. You hone this craft by doing it. So just with that, let me just jump in quickly to keep the pace going here. We are a discretionary global macro manager. We're distinctly in the minority in the managed futures space. It's heavily overweighted systematic managers. We actually like the fact that we're on the opposite side of most of the managers in the space. I can get into that later. So just really quickly, we describe ourselves as a throwback to 1980s, 1990s style of classic global macro investing. So what does that mean? What that means is we concentrate our capital on our best ideas. So we typically never have more than 8 positions on at any given time. Currently, we have 2 on. We got rid of most of them. We have multi-month to multi-year hold times in our core thematic trades. And then for our shorter term, probably long term for you guys, our short-term tactical trades are a few weeks to a few months. I'll hold off on getting into risk management, idea generation, and the rest, and I'll hand it off to Max.
Oh, thank you. Yes, Max, go ahead, please.
Hey guys, it's Max Nissman. My partner is not as cool as Awesome, but his name is G, so it's pretty cool. I agree fully with Roger. Academic background, no matter how accomplished, doesn't make you a good trader or money manager. So I won't bother to go through mine. Linnis is a small niche quant futures fund with a unique strategy. I think we'll have a chance to maybe get into why it's niche and why it's unique a little bit later. But we've been doing it for about 6 years now. The first half of my career was in a totally different realm in mortgage-backed securities. And it was around 2014 that kind of just lost interest. It was no longer a quantitative field, and my background had been a very, very quantitative academic background. So I partnered up with my colleague and co-founder G at BlackRock and launched in 2014. Thanks.
Well, excellent. Thank you so much, gentlemen, for the introduction. I hope our listeners and viewers are now a little bit more familiar, and I'm pretty sure that many of them have interacted or crossed paths with you in their lives and investment professions. So let's jump into the subject. This is where the interesting thing is. So to begin, I'm sorry, I forgot myself, so sorry about that. So my name is Dmitri Alexeev. I am the CEO of AlphaBot, and AlphaBot is a collaborative platform for alternative investment research. We are multi-data source. We focus on eliminating the need of spreadsheets in analysis, in enjoying the professional network structure where clients and managers and investors and consultants can exchange data, share results, build portfolios on the fly, and take seconds or minutes to do what usually in this space takes days and in weeks. So I'm bold enough to say that we take more than 10 times efficiency improvement, and there's many cool features, and AlphaBot system will be used today as background for the information backdrop for charts, statistics, and portfolios. You will see that yourself. And if you have more questions, you can always reach out to me or visit our website as well, where we have the blog and ability for you to test the system and many other cool features. So thank you again for joining. Let's now begin. Let's start with high-level overview of systematic versus discretionary strategies, because there needs to be some contrast, what exactly is different. And I will turn to John Stein with Kettera, who works with both kinds, so he can give us a high-level overview. And I think since we're talking about systematic strategies first, we will go ahead and show them first. So this is a systematic style bucket, or actually collection of style bucket of systematic classes from Kettera. And John, go ahead, please.
Yes, Dmitri, if you please, just click on manual and start it at maybe 2015 or 2016.
2015-01, that is easy.
Yeah. Anyway, the reason that we're throwing these graphics at you guys is just to kind of, it really, a picture does say sometimes 10,000 words. So in my case, that's always very helpful. Yeah, we've been looking at, as I think I gave you a flavor for it at the intro, I've been at this for 25 years.
And John, could you please speak up a little bit, because I think you're fading.
Okay. Can you hear me now?
Yes, a little better.
Yeah, the distinction between discretionary and systematic managers is a very important one. Now, most of the managers that are on this call today, and most of the people listening in, we're all talking about macro CTA commodities managers. We could easily throw in equity and credit strategies in this too. Most of those are discretionary. So for today's discussion, to keep this panel within its constrained time, if we start talking about credit and equities, we're going to be here all day. So let's focus really on what I call tactical strategies, which is macro, FX, commodities, everything that trades a derivative, whether it's over the counter or exchange. And that way we can have sort of a narrower, more focused discussion. In the group of those strategies, we divide the world first and foremost into systematic and discretionary. What you're seeing right in front of you right now is systematic. We've got 12 buckets, style buckets on our platform. Right now, let's just take the 3 that are equities off. And then there's some others, options, vol traders, so on and so forth, that have blended. It's probably half discretionary guys, half systematic guys. Let's take those off too. So what we did for this discussion today is boiled it down to 8 buckets, 4 systematic, 4 discretionary that are on our platform. For discretionary, you have right in front of you AI, machine learning, quant macro, short term, which is almost entirely systematic, and systematic trend following. And I guess what we're showing here is there's a point to be made to the industry. And if there's, for any of the investors and allocators listening right now, it's important to note, I'm sure that any allocator or investor who's participating today knows the difference between various systematic strategies in our space, but you'd be shocked how many institutional investors you run into and consultants that when they hear CTA, or they even hear the word systematic, they automatically think, oh, you must be talking about a trend fund. You're talking about Winton or TransTrend or Rotella or Systematica. And there's a lot more to this space, even in the systematic part of the space, than just trend following. As you can see right here, what we've known over the years, and it's illustrated on this chart, is that these 4 buckets act very different from one another. Now, there's a lot of overlap with AI machine learning, because in AI machine learning, by its very definition, can have lots of inputs. They can be trend, they can be price, they can be other things such as fundamentals. Quant macro, the quant macro bucket that you see, which is the, I believe that is the red line, that's almost entirely consisting of managers with fundamental inputs into their models. So you can see some of the peaks and the valleys in the VAMI line between these two buckets. Now, just let me pause to explain here for a second what's a bucket. I did not go out, or my team did not go out and survey the industry and found 30 managers in each one of these buckets. No, I want to be very clear. These are our internal buckets that we use for peer comparison purposes at Kettera. These consist of managers that are actually on our platform, or which have a full weight in each bucket, or are actually pending approval. That is, we've actually gone into the due diligence approval process, and they're given a half weight until they're formally listed. So some of these buckets have as few as maybe 4 components. Some of them have 11. So anyway, if you could move Dmitri to the discretionary buckets, please. Thanks. And these are the discretionary styles. Now, many of you are probably not surprised that the lines in the chart before with systematic managers, as much as I was jawboning it about how different they all are, and people get lumped in, painted with the same brush. Oh, you're systematic and you trade futures. Well, you must be a systematic trend follower. And I think I displayed evidence that that's not the case. Well, the difference between discretionary is even greater because of when you encounter a discretionary manager, it's essentially a manager that they might have some quantitative methods in the background, but essentially they're trading based on their experience or the team's experience. And they're looking at the markets. It could be technical inputs. It generally seems to be fundamental more than technical with these 4 groups. But for the most part, you're buying experience, you're buying a team, you're buying a human brain. And when you do that, and you're not buying a model, you might see returns that might be slightly less disciplined, less consistent. But you're also probably, the trade-off for that is you might also be buying into return streams that are actually maximizing profits in upward trends. There is a tendency among discretionary managers to possibly be more concentrated in one market sector than another at any one time, whereas systematic-based managers tend to be a little bit more disciplined about that. So that's why you see such wide differences. Dmitri at the bottom of the chart has thrown up correlations, and you're right, we did not do correlations for the systematic guys. We can bounce back to that if you guys want. But as you can see, the correlations here among the discretionary managers are quite wide and different. There's a couple of negatives there. They're all low. You don't see anything between these buckets that's higher than 20, hardly even higher than 15, I think. And that's really not surprising for the 4 buckets of discretionary methods that we have. Especially true is when you look at discretionary macro, which is the green line, those are managers that can trade a myriad of different asset classes all at once. Whereas the others, if you notice, are very much market specific, fixed income, industrial commodities, which is essentially metals and energies, and agriculture. So just by the very nature of what they trade, they're going to be different. Dmitri, just real quick, if before moving on, do you want to just shoot back to, let's jump back to the systematic group of 4 buckets and just show the correlation matrix.
I already did, yeah, but it's easy, but I already did. And,
oh, I'm sorry.
Right here,
I missed it.
They're a little bit higher, yes, as you can see.
Yeah, much higher on the average. And that's not surprising, but I don't want that to belay the fact that there are some very important differences. And we're going to show you later on you can actually have a very diverse portfolio and just combine systematic only strategies or discretionary only strategies. We prefer, if we were a client, to combine both together. We're going to show you that too. But even just systematic alone, while you can see the correlations are on average a little bit higher than the discretionary guys, you can combine a very diversified portfolio among these four groups. And with that, why don't we move on?
Okay, well, thank you so much for the overview, John. So now let's give the underrepresented, so to speak, a set of the discretionary manager on our panel, because there's fewer of them, as has been noted already, but they are actually pretty impressive managers. So, for example, for AG, Roger, please describe what you do in your strategy. Let me pull up some related numbers. And please go ahead. So here's AG Capital versus a couple benchmarks, and those are some more relevant, some not, but we put it in perspective. So here is the strategy. I can open your slides when you want me to.
Sure. Yeah, we don't even need the slides, but you can show them if you want. So we are probably the most simple, clear, and transparent manager that you'll meet as a discretionary global macro manager. For idea generation, fundamental analysis is the bulk of what we look at, and that is what's used to determine directional exposure. We look at technicals to determine entry, exit, and where we place our stops. You know, we do look at sentiment. We don't overly weight that, but we do pay attention to how the big funds are positioned. Just real quick, it's 100% US-based futures that we trade through CME and ICE, all US-based. Roughly speaking, 40% commodities, and then 20% across currencies, equity indices, and rates. It's a pure alpha approach with no underlying beta to equity. We aim for 10% annual returns or more. It's important to point out, we believe volatility is necessary to deliver strong returns. It's important to limit drawdowns, obviously, but an incessant focus on volatility means losing the ability to deliver the returns that we want to be delivering. So for risk management, it's the core of anyone in this business, I would argue. We risk between 15 to 100 bips on any given trade from entry to stop, and we buy, sell the number of contracts that allow us to stay within these risk limits for position sizing. So it's the distance between the entry and the stop that dictates position size. You know, just to give you a sense of how simple it is, we'll enter a trade, say we get stopped out, say we wait, watch, let's say we enter again, get stopped out again. Let's say the third time it sticks. It's only then when a position sticks and is moving in our favor that we add. So our margin to equity is only at the higher range that we post on our fact sheet when we're in winning positions. At the lower range is when we're getting constantly stopped out and going into cash. Our stops are placed outside daily, weekly vol. We feel that's necessary given the microstructure of markets and the shorter term algorithmic that it's made. We have to do that in order to not get stopped out consistently and die by 1,000 cuts. We work to limit monthly drawdowns to 10% and peak to trough multi-month drawdowns to 20%. If we're in a longer drawdown, we look to cut risk and position sizes as we approach a 10% threshold. Just a little bit more, like a kind of part of our philosophy, I guess you could say. We view longer term 3+ month market movements that occur for fundamental reasons, and that we think that the quantitative, algorithmic, high frequency trading impacts short term intraday to multi-day market behaviors, but it's not changed the weekly, monthly, yearly movements, which is the playing field we operate on. You know, we try to avoid the day-to-day and daily noise and operate on a longer-term time scale. So, I mean, I could stop there. We're very transparent in our thought process. We explain everything in person, you know, when the world reopens and we can meet face to face. And our monthly letters are very clear in what we're thinking, we explain our current trades, what won, where we didn't make money. we're agnostic about market direction. We're equally able to go long and short across all markets. And I guess important, you gotta eat your own cooking. A substantial part of our own assets are in the strategy. We believe it's the best way to compound our own wealth. Is roughly about $7 million of our own money in the plan, which at our stage, as an emerging manager, I think that's absolutely essential for investors to see that.
And the numbers are very impressive, Roger, I have to admit. And and I have a niche, if you allow me. So you see how different the volatility levels are between the benchmarks. So it basically begs for vol-adjusted comparison. And if we just force the volatility to be 15% for all the indices, you can actually see that even on that level, you are doing an incredibly good job and still managing the drawdowns. And let me see, maximum drawdown right there, right? So if we look at the drawdown chart, the blue one for AG Capital is basically hiding behind all the other indices, even though they seem much less volatile, much less drawdownish, but that was because we didn't put the volatility on the scale. So with the volatility normalized, it puts this in perspective, exactly what you said about drawdown management. So great job, thank you so much. So with this being said, let's now move to our next panelist. And for Rotella, can you explain your approach to systematic strategy now and how exactly you do that? So,
sure, Dmitri. So I think I'll start with the trend strategy. We, like I mentioned earlier, we have 7 unique strategies, and all the way from trend following to volatility-based trading as well. So I'll start with the trend strategy, which has been our longest running track record. So in this particular strategy, most people on the stock are probably familiar with the classic trend following model. So we do have a similar framework wherein we capture trends across all the 4 global macro sectors: equities, interest rates, currencies, and commodities. What does trend mean to us? It means different things. It's interchangeably used as momentum trading as well, depending on the time scale in which we are trying to capture that momentum. And what you see here is that
do you need the chart?
I'm sorry.
Do you need the slide?
No, that's fine. So what you will see is that, we try to capture signal to noise ratio across different time frames. So if, for example, what do I mean by signal to noise ratio? Let's take, for example, if you pull up the S&P's chart on CNBC right now, what you will see is, if you look at the S&P's chart from 2009 through end of 2017, you will see a smooth kind of trend, slow moving trend. It's a beautiful, almost straight line trend there. So that one would have a signal to noise ratio of 1, very conducive for trend following models to capture, because trend following models at the heart of it are capturing persistence in the signal to noise ratio. But now when you take from 2018, Jan 2018 to the current period, you will see the market has barely moved, but there has been a lot of big movements in between. And so that would be a market environment where the signal to noise ratio is closer to 0. So I mentioned that signal to noise ratio would be closer to 0 in longer, medium to long term timeframes. So in the shorter term time frame, you would see that they will be much higher in an environment like that. So it all depends on the time frames that you pick. And what we use right now is majority of our trend following models, our machine learning models. We use an ensembling technique wherein we take data from multiple markets to make a trade on one. And that's pretty much the difference between a classic moving average, trend following model versus our models. And but the objective of our trend following portfolio is the same. We are still trying to capture in the medium to long-term time scale. And we have found it to be incredibly stable as we have evolved into from technical to trend following, from technical models to machine learning models. And what you will see is even this year, for example, I think even in the March crisis, the CTAs were kind of flat. The benchmark anyway is not all CTAs, but the benchmark for the systematic CTAs, and we are doing phenomenally well in this environment.
And you also mentioned
you're
working on additional types of systematic strategies, right? And because one of the criticism, for example, for trend programs is that they are not as good as tail diversifiers as they sometimes claim to be. So can you comment on that? What leads you to the development of alternatives? Yes.
Right. If you could pick up, pull up the QDEC strategy there, that is
the one. Okay.
long only ML.
Which one?
Long
only
only
volatility program?
machine learning. Yeah, that's correct. Thank you.
So yeah, this one is a little shorter. Yeah. Mm-hmm.
Much shorter. So this is a situation. This is a classic model where what we do is we are long WIX, long S&P all the time. So one works as a hedge to the other, but we are long WIX all the time. So it's playing off. It's a neural network based machine learning model that alters the hedge ratio between the S&P futures and the VIX futures, and dynamically it predicts which one is there going to be a backwardation or contango in the WIX curve and in the term structure, and then determines whether to be overweighted in WIX or overweighted in the S&P. As you see, the phenomenon, it's convex. When the S&P goes down, WIX jumps up quite a lot. When the S&P goes up, WIX doesn't drop as much. So it's a hedge trade on the upside, but on the downside of the S&P, it really makes an impact. And the nice thing about being long WIX all the time is that it's able to pick up on quick turns. So if you had a medium to long-term trend following strategy, any CTA, systematic CTA strategy in your portfolio, you will see that there is a gap there. The turnaround time sometimes for sudden crashes like February of 2018 is not as fast. But if you think about strategies like this, what it will fill the gap between the turnaround time that it takes for medium to long-term trend following CTAs in a crisis situation to it will hedge you very well, because this will give you an instantaneous sort of a hedge to your beta exposure to the equity markets. And I can get in more into why, how it differentiates with a classic CTA strategy itself as we go along this panel.
Okay. Excellent, Will. Thank you so much. Now let's turn to Max and dig a little bit more into his systematic strategy. So what's happening in Linnis? How does that strategy work?
Yeah, so as I said earlier, it's a unique niche strategy. John went through a number of systematic strategies earlier, AI, quant macro, short-term trend. I mean, you can see from the correlations, those things blend together. So those buckets are not so distinct in certain cases. As Jag just said, their trend portfolio is now running essentially using machine learning techniques. So using essentially the same type of factors or features, excuse me, to learn off of that you would be using in a trend portfolio, but using a machine learning technique to maybe be more dynamic and weight those features more. So there's a lot of blending. Beyond those systematic categories, there's people who are doing systematic or quant spread trading in various commodity markets, as well as more focused commodity markets. Again, as Jag pointed out that there's a number of VIX versus S&P type strategies that are out there. A lot of those shops have done very well as of late, and some of them have also had a pretty strong track record for a number of years now. Yeah, and there's machine learning, but that's almost everybody these days is saying they're doing it in some form or another. In many cases, it just used to be called statistics. We're not any of these categories. What we would describe ourselves is event-based traders. There's a lot of things that make up events, but the idea is that there's certain things going in the market, whether it's options expirations or monetary policy events, economic data, other things that tend to be pivot points in the market and really the drivers of volatility and alpha opportunities in our philosophy. And what we look to do is essentially be price agnostic and just arbitrage these telegraph flows that occur around certain events. That could be in front of the event or after the event. But the main point is that there's a lot of people who follow sets of rules and regulations and are essentially non-economic traders, as we describe them. And we have the flexibility to not follow the rules and take advantage of that. So it's niche. I know there's some people out there, both in the discretionary side and the systematic side, that are probably doing some small portion of some of the things we do. Not all of the ideas are completely unknown, but we've decided to really make this our philosophy and our focus and create a pure alpha product from it. So the performance has been pretty good relative to most of the futures traders over the last almost 6 years now. Probably below our goals, but I think we're bringing it up as of late. And beyond the actual performance, we really showed no correlation to anything, which again I think is hard to find these days. And across the board, almost any strategy for various reasons tends to show some correlation to risk on, or some correlation to trend, sometimes both. So yeah, we just created a very niche pure alpha product. Dmitri, I think that's all I have. I mean, if you want to pull up the numbers, either our performance numbers in our slides or something like that. So yeah, I mean, that's the performance. We certainly have had hiccups along the road, but I mean, most managers can't boast of a max drawdown that's lower than their annualized volatility. So essentially what would equate to a calmer ratio that's higher than their Sharpe ratio. That's very rare. Again, correlations to kind of the two main benchmarks that a lot of people are looking at in my world would be the S&P and the CTA index. It's essentially zero in those categories. And these numbers overall are completely targeted in terms of vol. Our vol is very stationary because our opportunity set is essentially a reoccurring opportunity set. We're not beholden to getting certain technical signals or distorted markets. It's essentially reoccurring almost monthly frequency. And we have some pretty advanced volatility modeling techniques that incorporate events as well. So we're a 24-hour or less hold, and we're focusing on every single day as essentially an individual portfolio of alphas. And those alphas are gone within 24 hours, and we're looking at the next day at the new opportunity set we have and optimizing that day. You could probably go down to the correlation slide on 11. This just kind of shows what I was talking about with regard to a lot of managers showing correlations. So these are just the Barclays Barclay hedge fund indices. So with pretty much all of the guys other than the short-term and CTA categories and us, you see a lot of equity correlation. So distressed traders, long short, even global macro. When you look at a large portion of the global macro community, you see a risk on carry trade. Even fixed income ARB, which I thought was surprising to see that correlation to S&P. Then you look at the CTA indices, they're pretty low correlation to all of those categories, including the S&P. But you do see short-term traders and the CTA index as a whole, which is really pretty much a trend index. You see pretty high correlation between those two categories. So, even if your horizon is 30 days or whatever the short-term cutoff is versus, some long-term trend follower, I think these guys are picking up a lot of the same factors in the market and tend to show similar performance at times. And then, our category, we're pretty much along that straight line. None of the other categories we're anywhere close to anything other than zero. Bond index is something that we have some correlation to. A lot of that is kind of from early on in our first few years when we were trading 100% fixed income. That was our bread and butter, and we were originally portfolio managers in the fixed income space at BlackRock.
Well, excellent. That's a very impressive.
Dmitri, can I just?
Yes.
If I promise to keep it to 30 seconds or less, can I just pose a quick question to Max?
Go ahead, of course.
Max, on the chart in the lower left is very interesting. Just a question on marketing for any investors who might be listening. Do you find yourself when you go out to allocators, particularly institutional allocators, that you tend to get boxed in? Do you have to mount sort of an educational effort to, when you say two words, futures trading and systematic, is there a tendency to categorize you as a trend follower until you explain otherwise?
Not typically. I think there's enough knowledge out there that people have kind of differentiated between just being systematic and being trend. But it's certainly hard for people to place us. Over the years, we've changed our kind of story and how we frame it to a degree. I mean, not the details of what we do, but kind of the elevator pitch and what category we put ourselves in. We've kind of settled on quant futures. I just think it doesn't explain too much, and is really what we want to be thought of as really quant managers, and not necessarily just systematic. But people sometimes are like, "You're fundamental macro. You're like fundamental systematic, or you're systematic macro." And I'm like, well, I would actually describe myself as microstructure. I mean, I'm just trying to take advantage of flows that occur over 2 to 24 hours because of some kind of forced rules-based trader pushing the market around. Yeah, short term is obviously we will get categorized into. That's kind of a defined bucket at this point. But again, there's people in that bucket that are trading 30-day horizons and have pretty significant correlation to trend. So being different, I would just wrap it up and say being different is a double-edged sword. We've been able to perform through a difficult environment for CTAs and show no correlation. I mean, from a portfolio standpoint, if you put us in any portfolio, it's a huge add. Your Sharpe is almost always going up unless your Sharpe is already 5 or something like that. So that's great, but telling our story and trying to get people like comfortable with it has been very difficult, which is why we're still an emerging manager 6 years in.
Okay, thank you.
Those are good questions. But the results are still very impressive. I'm particularly impressed with the correlations. Yeah, they are very low. And you saw the equities as well. We can pull it up, but I think we saw them. Those are very, very impressive results for diversification. So, well, now I think we're ready, having discussed the pros. Having gotten overview of systematic versus discretionary, and also being enlightened that there's so many different kinds in each style actually. So it's actually much bigger space than many investors may realize by stereotyping managers to being either a trend follower or something else. So it's quite a rich universe, and let's discuss the core of this. The core topic today. So the pros and cons. So that's where the salt of the matter is, so to speak. And let's see. Let's say with Jack for Rotella. So Jack, what is your perception? How are investors viewing positives and negatives, and how do you view positives and negatives? So, for example, tail diversification issues or questions. What are the best and what, in your opinion, could be improved regarding systematic strategies?
Sure. Dmitri, could you please pull up my slide deck if you don't mind?
Yes.
Thank you.
So it's slide 4, I think.
Yep, that's perfect.
I'm sorry, I skipped it. This one?
No, just go to the next one where you had the scatter plots.
Perfect. Sorry.
The one that you showed, slide 4. Yeah, that's great. Thanks. So I'm going to compare, our trend following strategy outperforms the SocGen CTA index. However, what I'm going to do is I'm going to compare the SocGen CTA index versus just as a proxy for medium to long-term trend following, as that would be more applicable for a wider audience here. So when you look at this chart on the left, what you have there is on the y-axis, you have the returns of the SocGen CTA index, and on the x-axis, you have the S&P 500 returns. So essentially where you see that, where I have a circle there that says there is ambiguous tail performance. So that has been one of the biggest criticisms for, medium to long-term trend followers, is that they are not reliable tail performers. For example, in Feb 2018, it did not work out. Even in this environment, I would say that they were flat. They did not give up like Feb 2018, but they were flat. However, in 2008, during the financial crisis, they did phenomenally well. And there's a simple reason for it. First and foremost, trend following strategies, their mandate is not explicitly to target tail diversification. They have an absolute return mandate. They are trying to capture trends in the global macro markets. The second part about it is that the turnaround time for any change in market direction has to be substantial for the medium to long-term trend following strategy to turn around and provide alpha. So for example, the 2008 crisis, the peak to trough was approximately, I think, about 300 days. And the one that we had, Q1 of this year, it was approximately 30 days. So that's a much faster peak to trough than what we had in 2008. So in an environment like that, you can see why it may not be able to provide you the level of diversification you're seeking. However, it's done a phenomenally good job in some of the bigger, sort of longer bear markets. So there is a gap there between that kind of turnaround time and looking for some protection to the equity beta in the more shorter term space. There are short-term managers. Some of the momentum strategies that even we offer have done well, but there is another which I believe could be another complementary, more stabler option, which would essentially make the distribution look like the one and the second one there. So essentially, when you see the green circle there, what I'm saying is that there is much better tail diversification for the bigger sort of drops in the S&P. So if it happened instantaneously, like this particular environment that we were in, or Feb 2018, where the equity markets were going up in a straight line, and then they had this sudden drop within a week or 2 weeks. If you're looking to kind of protect your portfolio with that, this would be sort of, these are the type of strategies you want to add. That way you have more stable left tail, extreme left tail characteristics, hedges. But also one of the challenges with extreme left tail characteristics is that you pay a premium during normal market conditions. And the longer you go away from a big equity crash, the less you feel the need to, typically less justification is there for you to keep that in the portfolio. But the beauty of these kind of strategies that I will be talking about on the right there is that in normal market conditions, where in a equity bull market, what you will see that is that it actually has a positive expectancy. So it is a positive, it pays you to hold this insurance premium. So it's been able to achieve that. And that is primarily because of the way the S&P hedge works, where it's hedged with long only equity index futures as well. That way, if the index futures go up, it downweights the WIX positioning, and it gives you that positive expectancy. So if you go to the next slide, let's just dig into the model itself. I'll give you a peek into what the underlying signal itself is. The one to the next slide, Dmitri, if you don't mind. Thanks. So see, there is in this particular strategy that we built, there is a machine learning model in the middle of it, and it alters the hedge ratio between the WIX and the S&P. But if I were to summarize it in terms of just showing you what is it capturing, what is the market characteristic that it's really capturing to predict this hedge ratio or the change in hedge ratio, is very simple. What you see there is the WIX term structure. For most part, the WIX term structure is in contango. So, that brings a headwind when you hold long WIX positions, because every time you roll, you're going to pay a premium for that. But every now and then, it gets into backwardation. So during backwardation, typically there tends to be an equity, a crash in the equity markets. And when you observe the flip over from contango to backwardation, it overweights the WIX positions and underweights the equity index futures. So that's what it's capturing on. That's where the signaling happens. And one of the questions that I got asked recently was from an allocator is it too late? Typically people look for insurance policies after an earthquake. And the further away you go away from an earthquake, the less likely they are to buy it. So I said, well, actually, if you look at it right now, the WIX term structure has gone between contango and backwardation, back and forth. It's not strongly back to contango. It's still there where it flips around. And the other part of it is the WIX has actually dropped from its highs in mid-March substantially. So I would say, if given that it has a positive expectancy and a positive insurance premium, strategy similar to this with these kind of profiles may be a good way to add to your tail hedge bucket without having to pay a drag for holding these strategies. It's still, I believe it's still a good phase to hold it for the next couple of years, where you can still protect your equity beta, your beta to the equity markets, without having to delever or going to cash completely. This may be a good way to navigate whatever recovery and however it happens in the equity markets here.
Well, excellent. That's a great comment of comparing pros and cons. Max, what do you think from your perspective? What criticism do you mostly encounter? How do you overcome that? And what are your views on the positives as well of systematic strategies and recent developments?
Yeah, I mean, there's no specific criticisms that we get about what we're doing. I think I'm always surprised, and Roger may have similar sentiments. The inability for a number of investors, even sophisticated investors, to essentially adjust volatility. It's great that you've built an easy way to do that into this tool. Should say it's a really impressive tool, Dmitri.
Oh, thank you.
Yeah, it's like we target that volatility. We've communicated that through letters since day one. We target 20% gross vol. We pretty much shake out at 18%. There's a slight bias in our volatility modeling that we know, and we just don't fudge the numbers up. We let it remain. But we target that 20% gross vol and achieve 18% again with a lot of consistency, stationarity through time. If someone wants a lower vol product and lower drawdowns, we can just drop that number. We can just trade it half the risk, or they can give us half the account size. But that conversion is surprisingly difficult for people. So I think we run into maybe on the aggressive end for volatility for some managers, we run into that hurdle. And yeah, just not understanding, just really not getting it. I've certainly been in meetings where I've explained a trade. For instance, just the idea that there's a bunch of retirement accounts that are essentially on autopilot, reinvesting, paychecks and such into the markets. And that's kind of like a flow that we could take advantage of. And we explain this effect to an investor, and they immediately went to a chart of the S&P on their Bloomberg, and we're like, I don't see it. I was like, I'm not seeing this consistent spike that you're talking about. And I was kind of laughing, like, I'm talking about something that's, 55% hit rate. Like, I'm not sure you're going to see it with your eyes. So there's sometimes that, but generally no real criticism. It's just, it's when people aren't familiar with the product, it's difficult for them to wrap their head around it and get comfortable with it. So again, that double-edged sword that we deal with. What was kind of the other part of the question? Sorry.
So with the recent developments, because, excuse me again for my cold, I know that many systematic managers are exploring the new technologies, the new approaches, and artificial networks. And one comment that we shared with you when we were talking about this panel as well is the danger of overfitting, for example, because any half analyst these days can put a Python script and library with artificial intelligence onto his computer and then train it on the recent 10 years of markets and get the S&P run up, right, supported by whatever intervention and cheap money and so on, and then conclude that equities is the only worthy investment. Right? And unfortunately, this propagates to more serious investors who are actually supposed to know better, but still it comes up quite often as an argument. So what do you think about that?
Yeah, machine learning is the hot topic, sort of. I mean, some of the guys in that space have underperformed and had a lot of difficulty in March. So it's kind of going both ways, but it's still on a lot of people's minds. And I do think it is kind of the future. I think everybody is going to be using it to some degree or another. At the end of the day, just because you use machine learning, if your features aren't anything new, or you're not looking at the market in a different way, you're still just going to pick up the same effects. Furthermore, kind of what's your time frame with machine learning? I don't know if, a lot of people will probably watch Westworld on HBO. There's this machine that essentially was predicting the future at all times, very far out, knew all outcomes. I mean, that kind of idea that using machine learning to predict where the S&P is going to be in a year, I think we're a very long way off from that. I haven't seen anybody successfully do that. That's probably actually best left up to some of the discretionary guys. But on a very short-term basis, to understand how certain events, certain fundamental inputs, certain price patterns can affect the short-term movement of the market, and pick up non-linearities and discontinuities depending on what machine learning technique you're doing. I think there is a lot of value there. So it's certainly something that we're looking at and we're evolving into, but I think people just need to be really conscious of what's being done when someone says machine learning, because we currently use machine learning. It's called a logit model, and you got using econometrics for the last 50 years or more. That's now considered machine learning, I guess. But it's just, how are people using it? What techniques are they using, and how advanced with multiple ensembles and different combinations, multiple modeling techniques. It's a rich area. It is the future, but I hesitate when anybody puts too much emphasis on it right now. I think really the idea that you have and your approach to risk management and volatility are probably more important than your machine learning skills.
And that's probably also some thinking for investors as well, because not every machine learning is what it is. As I have discovered myself working with number of projects, sometimes people use the classical optimization technology or even regression, but because it's the machine figuring out numbers, you can, well, potentially, I'm not a lawyer, but you can pass it on as a machine learning technique as well. And that misleads investors often into thinking that they're getting something new and shiny. And then, John, may I ask you this question? Remember, we also discussed, there is this concept of a black box. So, and what we have touched upon is that there are different kinds of black boxes, because when investor doesn't know what happens in the strategy, it's not technically a black box, it's just not enough information. When the hedge fund manager doesn't know what happens in his strategy and the machine just runs, then when it is actual black box. So how do you approach those situations? How do you distinguish between the two black boxes?
Is that for me or is that for
Yes,
Max?
for John, yes, for you.
Okay. Yeah, no, this is a great topic because I got to say, and Max, I totally agree with you, and you too, Dmitri. Oftentimes, there's a whole spate of managers out there that do nothing but just optimize models. Just, you know, it's like it's 1995 all over again, and they just think there's this new rubric that they can use called machine learning and just slap that on top of their marketing literature, and boom, they're off the races. Hey, look, I've optimized my parameters in my trend following system. I'm using AI. And there's a large Ivy League endowment on the East Coast where the guy, I sat down and talked to him one day, and he was almost kicking his head back and laughing because he said, look, we're pretty smart around here. And he said a lot of us have backgrounds in data science. And he said, I can't believe how many people walk through these doors and take an optimized system and slap AI or machine learning. First of all, they don't know the difference between the two. And there is a difference. And then they just think that we're going to buy it. And what they don't realize is they've just slowly eroded their reputation. The way that we look at it is a black box. First of all, black box itself has gotten a horrible association with it. There's black boxes and there's black boxes. If you're looking at a sealed system by which you either pre-massaged data or raw data is fed in, and you can demonstrate how the processes work, how things line up, and you can talk about it and talk about the connections. Even if you can't describe what connections inside the box are happening, if you can talk about the input and the output, and the proof is in the pudding, in a disciplined, intelligent way, I think there's a lot of merit to AI and machine learning methods. If you are just basically taking moving average crossovers or breakouts and optimizing, let's see, for euros, we'll use 30 days, and for natural gas, we'll use 40. You're taking your a priori assumptions or your own experience, and you're feeding it and forcing it on an optimization engine. That is not black box. And that's often called black box, and they're criticized for being black box. The problem with those latter methods isn't that they're black box. Maybe the problem isn't that they're not black box, and they're basically just trying to overly massage a bad idea. And that's gray box, and you probably don't want much to do with it.
Excellent comment. So let's now ask the opposite end of the spectrum. So let's see, Roger, what do you think? So for obviously it's pros and cons more now for discretionary, but since everything is philosophically a pro and a con, like with discretionary managers, it's more relevance on experience on the team, right? But that can also be viewed as a con, because with the system you can say, oh, at least I could have known how it would have behaved, giving the inputs. With the manager who is discretionary and making decisions as the things progress, that again, it's much harder, right? You at least for now, until Facebook completes that project, we don't and Google, we don't learn people's minds too well yet in most circumstances. So how do you deal with this? What are pros and cons that investor wants to know about a discretionary type of strategy?
Sure. So I'll start with cons, then move on to the pros. I would say the primary con is typically something that most people never say directly to our face, but it's kind of implicit. So the primary con for a discretionary global macro manager is the perception of cognitive bias, both our own biases and of investors and allocators. You know, we all have biases, whether we are aware of them or not. I'm guessing most of us have read Dan Kahneman's book, Thinking Fast and Slow, which documents all these in detail. Our answer to this is risk management, risk management, risk management. You know, it's the best defense we view of a hardwired tendency for humans to have biases. You know, on the investor allocator side, the bias is reflected with the common perception that discretionary managers are sitting around looking at the screen and shooting from the hip. That's what they never say, but you know that's what they think. You know, when you contrast the marketing message of, you know, what can appear to be a very intellectually rigorous process of systematic managers embedded within a quantitative mathematical wrapper, you know, it's no easy task to overcome this shooting from the hip perception for discretionary managers. You know, we own who we are. We own our process as a discretionary manager. So I would say that is the fundamental con that typically no one ever says to your face as a discretionary manager. The pros, with that said, as a discretionary person, you know, I think I may have said this earlier, we like to say our track record speaks louder than any narrative we can spin. You know, given the inherent skepticism of the industry, which as it should be, the shoot from the hip implicit perception of a discretionary manager's, you know, it has to be overcome with the track record. You know, there's always going to be a flimsiness to it. You know, you can't mathematically model it, in our view. You know, so our track record is like the score of a sport. You know, humbleness aside, which is humble as an important aspect of this business. You know, we are up 40% year to date this year. We have an annualized return of 26% over 5 years. You know, we like to think this performance speaks for itself. Even among the mathematicians here, I don't think that track record can easily be swept aside as random luck.
I'm a mathematician, not to interrupt, but yes, I am a PhD in mathematics, and I do agree with you. There is a good, I think, Eastern proverb that the dog is barking, but the caravan keeps going, right? So despite the criticism and all the noise about it, you guys keep pushing and producing excellent returns, and that's the best proof that the method is working.
Yeah, thank you for that. So what I would add to that is, you know, we believe the competitive advantage is on the qualitative side rather than the quantitative. You know, that may be a controversial thing to say. You know, everyone's doing similar quantitative analysis in our view. We do not believe markets are a math problem. You know, markets are a human construct. We invented them. It's an unbounded space with variables ranging from geopolitical, economic, psychological, exogenous events like the coronavirus. These are all inputs into the system. You know, that's a lot, you know. And then I guess a few more points. You know, we believe that, to kind of add on that, we believe investing and trading is a liberal art, that it requires an understanding of history, philosophy, psychology, economics, putting all these things together, combined with our experience, which we do, and that's part of our edge. A couple more points that I wanted to make here is, you know, I'm going to give you a direct quote from Ed Sakota. He was one of the guys interviewed in Market Wizards way back, but this is a direct quote. He says, "Systems trading is ultimately discretionary. The systematic manager still has to decide how much risk to accept, which markets to play, and how aggressively to increase or decrease the trading base as a function of equity." So ultimately, we believe that. We drew that conclusion before I went back and discovered that systematic trading is ultimately discretionary. You know, these decisions are obviously very important, and last I checked, systematic programs are not programming themselves, you know, humans are. So we agree with that. You know, systematic trading is ultimately discretionary just in disguise. So I guess I don't want to make too many friends here today, so I'll stop there. But that's what I would say is my answer to the pros and cons.
I'm pretty sure that everybody is perfectly fine with your comment, and we started with a relatively controversial topic to begin with, so everybody knew what they were getting into. But I do believe that this is a very valuable perspective that investors need to be aware of. And here is the pickle that hopefully John can now try to address as well, so throwing the curveball to him. So how, from an investor viewpoint, do you deal with all this diversity, all these different styles? How do you take advantage of the pros, and how do you avoid the cons? So what would you, because you work with both kinds, as we already know, and you have to make those decisions and build portfolios, and sometimes work with clients who don't necessarily have all the answers. So how do you do that?
Well, one thing we did to help illustrate this, guys, is Dmitri, pull up the three, maybe go to the into AlphaBot and go into the benchmark comparison.
For the portfolios? Yes.
Yes, for the three portfolios. And you're going to see a huge word embedded in the name of each. We basically went back 1 year ago because we wanted to be intellectually honest and optimized. And by the way, can I just go on record for any serious allocator, we hate portfolio optimization. I've never believed in it. I think anybody who thinks it works, that's basically mean variance or downside variance based optimization. Looking backward, you're going to have a rude awakening going forward. Nevertheless, to illustrate this exercise and how discretionary and systematic managers can blend together in a balanced portfolio, we purposely went back and did just that. We broke all the rules and optimized. And by the way, you can optimize very easily in AlphaBot. The reason there's an optimizer in AlphaBot isn't so you can optimize. It's basically so you can get an idea of what has done well and maybe a starting point. But enough of my speech about the dangers of optimization. I think everybody knows that. So I went back and broke my own rule, and I optimized three portfolios. One of, I had 12 or 13 systematic candidates. Another one, we had 10 discretionary candidates, and the optimizer basically, and I optimized to Sortino. Some people are to Sharp, it's Sortino, but the downsides of the same. Anyway, why did we do this? Because I wanted to see if you locked in place something a year ago.
So I just want to highlight that, reiterate that optimization was done on the year-old data. So that's the point. So it wasn't. It was done at the May 2019. So somewhere here, and then you look how that portfolio works going forward. Yes. Right.
And essentially, I want to touch on something that Jag brought up, and that was, let's go to, this is an optimized portfolio. We're all like fooling ourselves, but just for giggles, if you want to, Dmitri, go down and pull up the, can you pull up the monthly returns grid?
The monthly returns grid, you mean for the, yeah.
Yeah. If you look at February of 2018, which is when we're all knocking ourselves that systematic, who did better, systematic, discretionary. On the whole, I will tell you this. That's where the conversation doesn't become a systematic versus discretionary conversation. Let's just focus on the people that, as Jag described, many people were disappointed with trend following back in February of 2018. What did well in February 2018 were certain systematic strategies, shorter term. What didn't do well was, as he indicated, trend following. And the quant macro guys probably somewhere in between that is fundamental inputs with a quantitative process. Anybody with a lag time in their models based on a data construct probably did not fare well in February 2018. In February 2020, a slightly different answer, but I think there was a little bit of lag time there too. But anyway, as you go back in time to February of 2018, Dmitri, if you could, on the right, you'll see that they all did a marvelous job. No surprise there, except for look at the CTA index. And that's because this is an optimized portfolio. So what I wanted to do, and I thought it'd be kind of fun, is before talking about how we blend the two, I'm going to tell you why we blend the two typically when we create portfolios. And that is, if in a portfolio that was optimized in the spring of 2019, a year before the market disruption of this year happened, or at least 11 months before it happened, I thought it'd be really interesting to see how that optimized systematic portfolio versus discretionary portfolio went into 2020. And what happened is my overly optimized, purely discretionary portfolio was marched into the new year in style. Basically, they did just fine. February was.
Sorry, John, your sound is a little bit.
They did just fine. The February was slightly down. March, they hit it out of the park. And again, I want to tell everybody, this is an optimized portfolio, so nobody get excited. But it was optimized a year ago. And so something must be going on with these discretionary managers. And this isn't, these are 12 managers, candidates that you can easily find. Yes, AG is one of them, by the way, I'm proud to say. And there's several others. But a fine job in 2020. Systematic, by contrast, had a little bit more of a difficult time in this overly optimized portfolio. First of all, after May of last year, it immediately fell into a few problems in the second half of last year, and also in 2020. However, does that mean that systematic portfolios fall apart easier? No. What it means is you just need to watch and make sure what do you think is going to happen in the future. You have to take a much stronger hand as a portfolio allocator. When the building blocks of your portfolio are systematic, it's up to you, buddy. You have to keep an eye on your managers and know the market phenomenon that are going to make those systems profitable versus not profitable. That's not their job. They created a system. You know what that system is. You know what bullets are in the chamber. You just have to make sure that it's hitting the right target. You have to be more active as an asset allocator with a purely systematic portfolio. With the discretionary portfolio, you are ceding a little bit of a responsibility to guys like AG Capital, that they might know what the future holds. They might know what environment they're in, and they can morph accordingly and fit themselves to it. So you have to be a little bit more hands-on in a systematic portfolio. The third portfolio that you have on the chart is basically, we call the house faves. And it was sort of I don't know, the best 2/3 of one camp, the best 2/3 of the other camp. Again, a year ago. And it sort of struck a balance between the two. Probably the smoothest returns though. So what is it about how these types of strategies jibe with one another? If you notice in the house phase, the blended portfolio, which is blending discretionary and systematic, I don't think it should be any big surprise that, I'm just looking at the stats here and I'm looking at Dmitri's screen, that the Sortino ratio, which is what we typically like to look at, is the best. Is the overall return the best? No. Is the average annual return the best? No. But the risk adjusted, risk return ratios that we look at are the best. And also, I think the maximum drawdown is the least. So for a client, make the client happy portfolio, I think you need to have a decent blend of systematic and discretionary methods. And when you do that, you get a blend of that sort of forward-looking versus here's my model, you decide when to use me type of philosophies. And that's what we look at.
And we can take, don't mean to interrupt. So we can take a little bit of a peek under the hood, right, for a portfolio like this. So with the weights that are optimized to a particular, like this is a pure discretionary, as you mentioned, right?
Yes.
And you can still see that, for example, if we focus on this correlation table, let me show that up, statistics and data. So you can see that there is still so much diversity within these programs that still produce a wonderful result.
Yes, and by the way, just to note, the only reason AG wasn't included in this one
this is a systematic.
Is that this one was no, this is the discretionary.
Oh, I'm sorry. Did I mispronounce? Oh, yes, discretionary. Sorry, my mistake.
It is because
yes.
we had to go back to 2015. I think it was late 2014 for the optimization that occurred frozen in time.
Yeah. So intellectual honesty doesn't hurt. So yeah. So this, you see the portfolio, there's so many movements around it, and you can see different attributes of it and different statistics and correlation matrices. So this is the kind of kitchen that I myself was involved with as a CIO as well for a number of years. And this is what investors need to decide whether they are ready and willing to take that puzzle on, or whether they want to talk to somebody who already ate a pack of dogs doing this, so to speak. So thank you, John. Please continue.
Sure. Well, that's really it. I mean, and I also want to say that each one of those managers, there is nothing, those managers, we didn't go out and pick the top 10 percentile of their style class. I'm not going to name any names, but for instance, with a tilt towards our friends at AG, if I were to create a portfolio and I wanted a discretionary macro element, AG would be included. But we didn't want to go out and find the best. We also had to, like I said, we had to start in 2014, so we needed the data to do it. So we went out and said, okay, what's a good discretionary macro? Not the best, but what's a good solid discretionary macro group that people like? What's a good solid ag trader? What's a good solid energy trader? So there's nothing, we didn't go and cherry pick the best and then throw them all together. And it shows that when you blend, sure, certainly this is an optimized portfolio, but I'm talking about going forward, not going backward. Going backward, of course, it looks spotless. But going forward, I was surprised that even with managers that may not have been the best in class, as they got blended in the discretionary portfolio, they reacted to a vastly different market in 2020 very, very well. But they reacted to it very, very well together. Maybe not the best performance in their class together or the worst, but this is the strength of portfolio construction.
Excellent comment. So I think we conveyed the main message that the topic of this discussion was. So we reviewed the strategies, we looked at the differences and actually internal diversity of each group, be that systematic or discretionary. And we touched on the subject of pros and cons, because there's a few to be aware of on each side, of course. And we looked at how an investor can approach this challenging task of building a portfolio and selecting the right managers and the right mixes, and leading with those decisions on an ongoing basis, because markets keeps changing. I don't see any questions in the queue, because there is actually a chat feature. I hope I didn't screw that up, and it should be enabled. So if you do have a question from participants, from attendees, you can just type one up in the the chat, but for now I don't see any questions. And if we don't see any, then I think that's about it. Do we have any other comments or questions from the panelists to each other maybe, or anything that makes it interesting? Anything you want to touch upon? We have a couple of minutes more.
Looks like we have a question.
Oh, we have a question, and for some reason I don't see it pops up, but it's, let me see chat. Yes. Okay, here. So that's, what are some due diligence questions? Paulson Hauser, thank you so much. What are some due diligence questions that investors should be asking that are not, that they are not asking, you mean, I think. So, okay, anybody on due diligence questions that investors should be asking and that they're not asking?
I can address that.
Okay.
I think that well, one is one that I talked about earlier, and that is when you confront somebody who says that I use AI or machine learning methods. Many investors are, like the foundation I cited on the East Coast, aren't sophisticated enough to know the difference and ask the questions. Investors need to, I know it's a very painfully difficult area and it can get really wonky, and nobody wants to have to go out and get a master's in data science. But it is important for investors to ask and say, when you say AI, when you say machine learning, what do you mean? What does that do for you? There's a lot of people marketing, and I don't think this one sneaks by institutional investors, but certainly there's a lot of family office investors out there that just get completely fogged away by people using the latest terms of art. So I think they have to ask more questions about why is this machine and what does it do for you? Let's say I believe that in this process of machine learning, what is it doing for you? Why are you just slapping this on your marketing material to make my eyes open? Okay, they're open, you have my attention. But what is it actually doing for your process that makes it so much better than if you created your system yourself?
That's a great question. And there is another one for Rotella as well. So does your research engine primarily look at price inputs or also fundamental inputs?
So what we do is it depends on the strategy itself. For example, our systematic trend or volatility strategies take price inputs and derivatives of price. But in terms of there are other intraday strategies where we use news feeds and sentiment data to trade, where and we do not use any price data there to see if we can get complementary or uncorrelated signals that are coming from different alternate data sources. So it depends on the strategy itself, but primarily the ones that you are looking at with an AlphaBot here are price.
Excellent. Well, thank you so much. I don't see any additional questions. I think we're perfectly on time. Yes, go ahead.
I would add to Colson's.
Yes, go ahead. Sure.
From our side, the one thing that I find interesting is that many people are so focused on things like notional exposure and stop losses and other mechanisms for risk and risk management. But for probably a number of reasons, one of them being just that it's a more technical mathematical subject, but just the idea of like how people are forecasting their volatility and sizing their trades. A lot of people say that they're vol adjusting their trade sizes and stuff, but I mean, I'm not sure what their vol model is. For us, it's something that we focus significantly on, and we consider one of our edge, our volatility forecasting techniques. But I think what we've seen throughout like these large market movements, especially in March, on both the upside and the downside, is that I don't think people have a really good grasp of that. And you can see that people's returns are very non-stationary. As you know, they might be making and losing a couple % here and there every month, and then they'll have a 20% up month or a 20% down month, and that just calls into question how they're actually understanding the market and what the volatility is in the market. Stop losses are one way to take advantage of that. Obviously, some managers have a positively convex profile or some kind of long volatility profile, so they have that positive skew. But in a lot of cases, I think a lot of this is just missized trades, and it's not about notionals. Like a 2-year Treasury future, the notional on that versus Apple stock, like who cares about the notional? And stop losses are one mechanism for risk management, but there's much more to it than just simply having some stop loss in your portfolio. So the volatility thing is really something that I think should be emphasized more and dug into on most managers. That's all.
Okay, well, great. And I think we have the last one. And if people want to hear it, I think it's an interesting question. So is a smaller emerging systematic manager more reliable than a smaller emerging discretionary manager? Probably because of reliance on the system versus people and research resources. Anybody wants to comment on emerging managers, discretionary versus systematic? Well, I guess it's John then for kind of putting it in perspective. Any comment on that?
I think that you can make an argument that a smaller, if you're going to have to rely on a team, and I know that AG, for instance, is probably smaller than your average, global macro behemoth that's out there, but they're also very good. I think that there is a chauvinism out there by investors that, and I think actually it's often career protection or bonus protection. I'm going to go with the big guy because if something nasty happens, I won't get fired. But I do think that I wouldn't necessarily advise a client, look, I got $10 million in my family office and I want to go into emerging manager, should go systematic or discretionary, to base the decision on whether they're okay. I know that a priori it seems like it makes sense that a guy that has a system can basically have a lean staff, and he's got a system, and as long as the data feeds and the lights don't go off in his office, he can trade, right? So I think that emerging guy's got a better chance of staying alive and probably not getting sidewhacked than the discretionary guy. But I'm not sure that's necessarily true, because it's just different kinds of resources. Maybe it's not human resources and human minds at work. You still have to feed the beast with data and maintaining systems. So I think that here's what you have to do as an allocator. If it's a smaller emerging discretionary manager, you have to ask more questions. Where's your mind at? Where's your mind at? What is your idea generation process as a human and your team of humans? A lot more questions about that and support than maybe you have to ask the systematic guy. But I don't think you should tilt in favor or away from one or the other just because one's systematic and somehow there's this assumption that they're more resilient because they're systematic.
Well, excellent. Thank you so much, gentlemen. I think we are done time-wise, and let me thank our attendees who we actually did this for. So thanks everybody who could join, and we appreciate your attention and your time spent with us. And of course, thanks to the panelists for providing such an honest and wonderful comment and description. So I do appreciate that, and the fact that you were willing to step into the spotlight and discuss not just the positives, but also the negatives. I think that has a lot of value for especially investors, but the industry as a whole as well. So it's very valuable. So thanks everybody. And with that, I will close the meeting.
Thank you.
Thanks. Bye.
Thank you so much. Have a great day, gentlemen.
Bye.
Bye. And ladies, of course, too.